Oxford Economics just released their latest forecast for Canada's economy, and honestly, the outlook remains challenging. The firm expects the economy to stay weak through 2025, with housing activity picking up, but prices still expected to slide in 2026. Here's what this means for Canadian households considering buying, selling, or maintaining their homes. Oxford Economics expects Canada to remain on the edge of recession through 2026, warning that broad-based weakness across the economy shows little sign of improvement. The unemployment rate continues climbing, with projections showing it could reach 7.4% in the second half of this year, while economic growth remains nearly stagnant with only minimal quarter-to-quarter improvements. Several factors are weighing on the recovery. The labor market is softening, increasing the likelihood of layoffs for many Canadians. Policy uncertainties around tariffs, upcoming federal budget decisions, and ongoing inflation management efforts add further complexity to the economic landscape. However, there is one bright spot. Inflation appears to be moderating faster than initially anticipated, which could provide some relief for household budgets. The housing sector presents a mixed picture. While market activity is increasing with more listings and buyer interest, Oxford projects home prices to fall by 8 to 10% by mid-2026. This does create a buyer-friendly environment in the near term, but meaningful price recovery remains distant. The forecast suggests sustained price growth won't emerge well into 2027, held back by affordability challenges, weakened demand, and demographic shifts. Even as transaction volumes improve, the underlying fundamentals continue to favor price declines. Adding complexity to the housing outlook is the federal government's ambitious construction targets under the Build Canada Homes. If these projects accelerate faster than demand recoveries, some markets could face temporary oversupply issues, further pressuring prices in the short term. So what's the impact on Canadian households? Rising unemployment will strain more families with income instability combined with elevated living costs. Household budgets face increasing pressure. Even families not directly affected by job losses may adopt more cautious spending and investment behaviors, including hesitation around major housing decisions. Uncertainty about job security has already caused consumer spending patterns to shift, with households prioritizing financial stability over major purchases. Now, there are several policy developments that could significantly influence the economic trajectory. The federal budget dropping later this year, it could introduce new spending measures or cuts that could alter the growth prospects of the country. Trade relations, ongoing tensions around tariffs, and the USMCA trade agreement negotiations continue to weigh on business investment, though resolution could unlock improvement. And monetary policy, the Bank of Canada's approach to inflation management and interest rates remains central to both economic and housing market outcomes. The bottom line, Canada appears to be locked in a prolonged period of sluggish growth with significant challenges ahead. The housing market, while showing signs of life, continues its search for a price floor. For households, the message is clear. Economic uncertainty warrants careful financial planning. Whether you're considering a home purchase, sale, or simply managing existing housing costs, recovery appears years away. This means patience and financial prudence are a must to help you navigate this extended period of economic weakness. Thanks for checking out this video. If you found some value here, please consider hitting the like and subscribe button. And if you like this type of content, you're gonna love this video as well.